Hi, I'm Jen Benepe, and this is The Real Deal. Well, some are calling this the worst financial shock since the Great Depression. Financial firms once considered the bedrock of the financial sector have toppled, and funding for mortgages and lending are virtually frozen. While New York's commercial and residential markets were softening before the financial meltdown, it's now clear that the pain for the city's real estate community could be far more severe. Here to talk to us today are two financial experts who are featured in this month's Real Deal magazine. One will talk about the residential market and the other one will talk about the commercial market. Your third quarter numbers just came out and there's some very dire predictions in those numbers. Tell us a little bit about that.
The key numbers for the quarter really are the idea that sales activity was down about 24%. Year to date, we're down about 26% compared to the same period last year. On top of that, we've got inventory that is starting to rise.
Now, we all know that Wall Street cash bonuses were driving a lot of the business in the past few years. Yeah. And now that the bonuses are shriveling up and people have lost their jobs, how's that going to change the landscape?
Well, it's not good news. I think that's pretty obvious. The financial services sector accounts for about 5% of the jobs, but 23% of the income in New York City. So now you have a forecast of layoffs in the financial services sector of anywhere to 50 to 65,000 employees from the beginning of the credit crunch to whenever this thing stabilizes. On top of that, bonus projections are well off. In
a normal recession, this might be a good time for people to gather in and go and buy some cheap real estate. But now credit is tight, so will the government bailout help those people get mortgages?
That's the objective. No one's quite clear on whether it will. The idea is if you promote liquidity within the financial system by injecting cash or capital into it, that lenders will be more willing to lend.
Now we'll talk to Ken McCarthy about the commercial market. It has been reported that some major corporate customers are pulling out of their leases, like HSBC pulling out of 7 World Trade Center. And would you say that much of that is going to happen over the next 6 months or a year?
Well, clearly what we're in right now is an environment where landlords are going to be battling over tenants. Tenants who are looking for space are going to have a lot of options, and and landlords who have those tenants already in space are going to do everything they can to keep them.
So prices should come down and incentives should increase as well?
We're already starting to see that. The incentives to stay, the additional concessions that landlords are willing to offer have come down pretty dramatically. I'm sorry, the incentives have increased. The prices are starting, and as a result of that, the cost is starting to come down for tenants. And we would expect to see that continue in the future.
Ken, we know that some firms may be putting other space on the market. What is that going to do to vacancy rates around the city?
Well, it's clearly going to have an impact. We know that although Lehman has been acquired by Barclay, or pieces of Lehman, that some space that they had occupied or had leased will be coming back to the market.
Now let's talk a little bit about the employment situation. You expect 40,000 layoffs, you told us, within the city's finance sector. How would you say that's going to impact the city citywide in other jobs, and what kind of impact will that have on commercial space as well in the market?
If we're saying 40,000 financial jobs, we're probably saying another 15 or 20,000 jobs in other supporting industries. That means that we're looking at a total of something on the order of 50 to 60,000 jobs. 50 to 60,000 jobs could mean as much as 15 to 20 million square feet coming back to the market. However, not all that space will come back because businesses don't always put it back. So we think that a reasonable number to assume in the short term is that we will see something on the order of 10 million square feet, maybe even more, come back to the market.
Now there's some of the biggest projects that have been in development, some of the big names like Related and Tishman. Are they going to have trouble getting funding? And what's going to happen to some of the big developments around town like Atlantic Yards and Hudson Yards?
Well, I think right now the current environment where credit is extremely tight for everyone, major corporations throughout the economy are highlighting the difficulty in getting even overnight money. In this environment, companies that are construction lenders or are construction companies and developers are going to be challenged to find the financing.
Well, there'll be more information coming as this financial crisis continues to unfold. I'm Jen Benepe, and this is The Real Deal.